course, that those of you that maybe are just getting started on your 14-day free trial, this is what it looks like when you log on to your PowerOptions account, onto your trial account. And I want to encourage you, of course, to take advantage of these 4 steps. You can access that quick start guide. There's a variety of flash tutorials that will help you get familiar with the tools on the site. There's a variety of archived webinars. We also have live webinars during the week, but you can access the archived webinars at any time. Categories on using the PowerOptions tools. Option strategies, including management of different strategies and more. There's a category on options concepts. And of course, all of our Friday discussions are archived in what's called the requested topics category in the free webinars. And last but not least, any trial member or subscriber can schedule the free coaching sessions at any time. It's not just one and done. You can have multiple sessions during your trial or as a subscriber. You can just click that free coaching link there, either on the 4 steps or as a subscriber, you'll just see that link up here underneath the main home tab. Click on free coaching and you'll be able to schedule a time that works for your schedule. And you'll talk with Ernie or myself for 45 minutes or an hour. All right. All of that being said, we saw some movement in the market this week due to, of course, tariff discussion once again. New tariffs instituted today as well. And, the talk about what has happened, what did China do, what did China not do, what we're going to do in response as well. So the market kind of took that news with a little bit of jitters in the beginning of the week, and it sort of calmed down today. The VIX, the volatility index, gave back. It was up at high as 20 at one point, I believe, over 19 definitely, but then it gave back later on as well. Settled down a little bit, market sort of turned, saw a little bit of growth also. Now, if you're in a position that maybe fell a few points over the last 10 or 15 days, or even in the last 7 or 8 days, or even the last 3 days, and you're looking for a way to maybe get back to break even faster. Of course, one of the things that you'd want to take a look at here is our stock repair tool. It's a really simple tool. You can access it quickly by just putting in your stock symbol here and clicking stock repair, or you can access it underneath the signature tools tab. Now, what this tool does is to help you try, it calculates for you if it's available. I'm going to use Trex as one of my positions. We're going to go into stock repair. It's ended today at about 61.30, I think was the last I saw, maybe 61.50. But I'm going to put in a cost per share of, say, $65. I know it's not a big loss. It's only $3 or so, about 5%. And let's say I have 100 shares. Okay, now what this tool did, it found repairs for my position. They're out to December. I would typically like to see them closer in, but it's not available right now. Oh, Trex rebounded very well. It came back up to 63. So, yeah, that's okay. But so we're still down a little bit, but we do have here, naturally my break even would still be 65, but I can get a break even at 60.60 or 62.50 by using a ratio combination, a stock repair of a 60 and 65 strike for December or the 60-70. Now, what does this mean? I can generate a credit of 380 to help me get back to break even faster. Let's take a look here now at the repair details. And what we're seeing here is that the computer calculated for us that we could buy one, since we have 100 shares. If I had 300 shares, for example, it'd show me I'd be buying 3 of the December 60 call at 10.20. Now, at the same time, I can sell 2 December 65 calls for $7, which would bring in $1,400. So we'd have a total net credit of $380, which would naturally lower our break even down to 60.60. Now, wait a minute, that doesn't look right, does it? If my cost basis was 65 and I enter a spread here that brings in 380, shouldn't my break even be 61.20, not 60.60? Well, here's the trick. I'm buying 1 call and selling 2 higher. This is essentially a covered call with a 65 strike combined with a bull call debit spread. Buying a 60 and selling 1 of the 2 65s. So as the stock moves up, my long call is going to gain in value. And once the stock goes up to 60.60, well, I keep the 380 net credit, and I keep the 60 cents value. I could sell to close the long for 60 cents, and I'd be at break even. Okay, didn't need the stock to go back up to 65. Now, in this case, it might not be worth it, to tell you the truth. I thought last I looked at it, it was at 61.50. I didn't look at it at the end of the day when it rebounded back up to 63. With only a $2 loss on the position, I'm probably more likely to just be selling an out-of-the-money 65 or 67.5 call 1 or 2 months out. But for when you have a larger decline and you don't think the stock's going to move the 8, 9, or 10 points back, the stock repair could be very useful. What does it actually look like? Well, let's take a look at the analyzed trade next to our 60-65 strike. This will take us right over to our profit and loss chart. My apologies. There we go. And sorry about that. With everything involved, what we end up seeing is sort of a plateau max return of 14% if the stock reaches back to 65, which is originally our break even if we sat around and we did nothing. Okay? Why? Well, again, because remember, we're long 160 and short 265s that we got at a credit of 380. So as the stock goes up to 65, what happens? This long call is now worth about 5 points, maybe a little bit more if we still have some time value remaining. So we could close the debit spread, take the 480, 470, 490 back from that spread even before expiration, if it's trading up near 65. Maybe not that much, maybe about 450. But we can get that back out of the spread and then maybe adjust our call up and continue it as a covered call position. But we're more than close to back to break even because of the structure of that trade. That's the stock repair tool. You can use it to help identify repairs to help you get back to break even faster. In addition to that, if you have current stock positions that are down in price, I want to remind you that you can go to the webinars page at any time. This is a public page, actually. You don't need to be on a current trial or a subscriber. I'll send the link to everyone, poweropt.com/webinars.asp. And there's the categories that I had mentioned. And underneath the options concepts, there's a presentation here on manage your broken position. It talks about alternative methods for managing a stock position that has fallen in price. Even if your stock has maybe fallen 10 or 15%, you didn't have protection in place, you may still be able to use that stock repair tool by averaging down first, getting a new cost basis, and then applying the stock repair to get you back to break even faster without needing that 10 or 15% increase on the position. Also, ideas on a covered call position that has moved against you, managing a naked put that maybe is now in the money and you're going to be forced to buy shares of stock or pay a lot of money to close that put. And there's some brief conversations on managing bullish spread positions as well. So that's under the options concept section of the webinars page, manage your broken position, for further insights on managing positions that might have gotten a little away from you this last week or these last few weeks as well. Now, in addition to that, some of you may have gotten into positions, let's say at the beginning of January, and you were holding the positions, you maybe sold some calls against it, or maybe you were selling naked puts against it, and then you got the stock put to you. But your cost basis is actually lower. So for example, let's go back a few months here. I'm going to go to the quotes page, stock page for Trex. We see, of course, it's at 63.04. It was as low as $61 today. It rebounded up. It was up near 76 2 months ago, a month and a half ago. I'm going to go back as far as I can to March. Let's just go to March 1st historically. Excuse me, March 11th historically. Okay, the stock was really high. It was at 73 then, so it was at the peak. Let's just take a look at the stock chart real quick. I just want to see where we were at the beginning of January. I don't remember off the top of my head after that decline from December. There you go. Okay, so December 26th, the bottom is at 55. Okay, so let's say with the stock at 63 now, that's good. Let's say we got in right here at about $59 per share towards the end of December, after the market started to rally before the large rally up. Then we had that huge dip, and then it came back. Let's say we own Trex at $59. We saw it as high as 76, didn't take advantage. It popped back down to 59 here, went back up to 76, and now it's back down in this range, but it's recovered a little bit more. Okay. So now if I have a stock that I've been trading or selling calls against, we have a lower cost basis. Let's say my cost basis now after selling some calls or making some trades on TREX is actually down to about 57.50. What I want to do in this case is I can go to the signature tools section, volatility skew, market sentiment, spread chain, long option finder, stock repair we just looked at, but I want to look at the stock insurance. So we've got our cost basis around 57.50. I'm afraid there might be some other pullback. I didn't take advantage of it too much when it was up at 76 either time. So now I want to see, is there any way that I can lock in some of this profit if I'm a little bit skeptical of the market or worried that in the next week or two more volatility and more downfall might come about from these tariffs, trade discussions, and more. Things going on in North Korea, of course, things going on in Venezuela. All right, so stock insurance tool is a real simple tool to use, just like the stock repair. All I have to do is put in my stock symbol, my effective cost per share. We got it at 59, but we've lowered the cost basis with some calls and then maybe had to buy some back. We're at 57.50. We could sell it right now for 63. Or if my plan is to hold it longer term, I'm going to leave the buy put month at all expirations. Okay. So we see here we have about a 9.6% unrealized gain on TREX. And what we're shown here is that we can purchase various put options at kind of a cheap price. And some of these look expensive, but again, remember, since my cost basis is 57.50, if I just went out to June for a month and a half of protection, I could buy the 70 put for 7.55. Now my new cost basis would be 65.05, but I'm guaranteed to get 70 back. So I've locked in 7.6% of that unrealized 9.6% profit. What does that mean? That means that even if the stock falls further, it drops back down to $59, $57, $56, the worst I could do is make 7.6%. It's a bulletproof position for the next 42 days, 45 days. Okay, so we see that we had the cost basis of 57.50. We didn't get as much advantage as we wanted when it was up at 76. It's fallen down to about $61, but now it's come back up. I say I want to insure myself. So by adding this put, I now have a cost basis of 65.05, and the worst case scenario over the next 45 days is I could make 7.6%. But if the stock goes back up to 76, we left that upside open even with the cost of the put. Now, in addition to that, knowing that we have expiration coming up in a few days and the stock sort of moved back up, well, I could say, all right, well, I can go further out in time, or I could keep this. Now, it's not really good for May in this sense. The 70 call is not really offering anything with only 7 days left. I'm sorry, I said 11. But if I went to June, got a little bit of premium at the 70 or the 75, I can still sell a call against it. Or I can just wait if my expectation is the stock's going to move up, but I'm not sure, which is why I'm buying the insurance. Okay, and get ourselves a little bulletproof collar with the max worst case scenario would be a profit of 8%. Negative risk means positive profit to the downside, and a max of 15.7% if by June the stock does go above 75. So that's how you can use the insurance tool. If you've been holding stock that you were buying when the market was starting to ramp up in January, you gave a little bit back, but you're still in a profit. Don't necessarily want to sell. You want to hold it a little bit longer. You think the market's going to recover, but you're worried about further downfall. Go into that insurance tool. You can access it under the Married Put tab or the Collar tab, or right underneath the Signature Tools tab. Just put in your cost basis and leave all expirations. Now, if I wanted to hold the position further, my plan was to hold it for another 3 or 4 months. I'd actually get a lower cost per day, not lower cost up front, by buying out, say, to October, 160 days of insurance, 224 out to December. And we can look at the different locked-in profits there as well and still be able to sell calls against that in the short term or in the near term as well. Okay, so those are the two tools I wanted to mention after this week's performance with the volatility, tariff, trade talk, and more. And that gives you an idea. Remember the stock repair tool, just put in your symbol and click on stock repair. That's the fastest way to access it. Or of course, underneath the signature tools tab, you get the stock repair tool or the insurance tool if you want to try to lock in some of the gains on your positions that you have a no risk bulletproof trade going forward, still able to realize further upside and locking in most of that unrealized profit. Comment comes in, why not just use a stop order? Why pay for anything? Well, okay, stop order is good, but think about it this way. If I set my stop now at 61, now that the stock has moved back up, I set my stop at 61, and on Monday some more bad news comes out over the weekend and the stock suddenly gaps down to, let's say, 56. This would be a large move, but let's say it happens. The stop order doesn't get you out at 61, does it? No. It's a market order at that point, meaning that you put in a stop to close it. If it's anywhere below 61, the market opens at 56, your order is triggered. They can only give you what the market's giving you, so you get 56. You've still taken a loss of $1.50 from our cost base of $57.50. In this scenario, if the stock gaps down to 56, guess what? I can still make 7.6%, probably a little bit more. That's the worst case scenario if there's no time value left on that put option that I just bought. But since it's still 42 days out, and this gap just happened, and implied volatility probably spiked in that case, I can probably sell that put for much more than the intrinsic value. Take some of the time value back as well, and I'll make a little bit more than that 7.6% instead of taking a loss with a stop order that can get violated. Or, with the put option in place, if the stock gaps down on Monday to the 56 area, I can choose to do nothing. Right? I have the opportunity. I can leave it alone. I control the put because I bought it. I don't have to do anything. Whereas in the stop order, you would have been taken out right away. Without it, yes, you could buy the stock back, but you're going to pay for commission to sell to close the stock at the market order with your stop order now triggered. Then you're going to have to wait a little bit, say, okay, it's settled down about 55.50, so let me buy back in. There's another commission. I make the decision what to do here. I can stay in it, and I could do other spread positions against it to sort of generate an income and increase this bulletproof status while not giving up my unlimited upside profit potential as well. That's some of the concepts that's discussed in the blueprint. All right, so I just wanted to review those two tools again. What you might want to use now that the market looks like it's starting to recover. Things are starting to settle down after the recent pullback with the tariff talks and more. Stock repair tool to fix the stock that's fallen. Then on the webinars page, under the options concepts, you can take a look at that for manage your broken position. And if you still have positions that have an unrealized gain, maybe you're a little bit worried about further declines, again, you can go to the insurance tool in the signature tools or under the married put or long collar tab to see which put options might give you the best locked in profit on your position. Okay, so we of course have been open all this whole time for questions. If anyone has any questions, go ahead and send those in. Okay, here's a question from James. Yeah, it's James, I'm sorry. James says, Mike, I happen to be on 10% down. Yeah, I'm sorry, 10% down on MSFT. Would the stock repair tool work for me? Well, let's check it out. First, I'm going to look at the quotes page. You said 10%, James, but did not give me a price. I just want to see where it is now. Okay, because we're at 127.13. So down 10%. Yeah, you're probably at what your cost base was probably about 140. I'd say $13 now, 140, be 14. Yeah, let's call it 139. Roughly would be 10% down. Okay, so I'm going to assume you're around 139. Let's take a look. Let's go to stock repair. Cost basis at 139. Just assume a number of shares 100. Okay. So yes, they're far out. So no near-term positions could be purchased. Okay, it tried to build repairs for you for May, for June, and for July. Could not be calculated with the credit you received. What this is telling you is that you could do this ratio spread, for example, in September, buying 125, selling 130s would give you a net credit of 270. That would put you at about 139-ish, 139.80. 130.80, my apologies, 130.80, and then the 5 points back would put you at 135.80. So that's why it didn't get you back to break even. Okay. All right. So, but you see that there are repairs out to January as well. Ones that can get your break even from 139, roughly, I said, down to 129, down to 131, and the stock's at 127, but they're further out in time. Okay. As well. So that's one thing you look for. Binh sent another one in. Can we look at a stock repair for BABA, which I acquired at 182.50? Okay. All right. So again, we're just putting in our symbol, putting in our price. There you go. Now the stock's at 178. So you're only 4 points down, 4.5 points down. There's a lot of repairs here with the 177.5, 180, 177.5, 182.5 gets your break even back to 178.40, 179.45, all for May. Different expiration. Why you're seeing so many Mays? I'm sorry, that comment. Why are there so many Mays? It's because BABA offers weekly options. So we're probably looking at this expiration 7 days away, plus the next one 14 days away, and more. So yeah, there's a lot of repairs here. I think the Mays are fine. You don't have to necessarily go for the net credit. I'm going to take these two ones down here, these two as a comparison. It's not showing me the date. That's something I meant to get on the programmers about here. And this is right around where the stock is right now. One's at 177.73, one's at 178.73. Okay. Now we think that the lower break even at 177.73 and the higher net credit on this ratio spread of 455 might be the better trade. It's not necessarily the case. Why? Let's take a look. I'm going to analyze trade on this one. Okay, going to get our profit and loss chart. This would be buying 31st May. And I'm not even sure if that's the expiration. I'm not sure if the market's closed that day for Memorial Day or not. I have to check in on that. Okay, but in any case, we've got 177.5, buy 1, 745. Sell 2 180s for 6. That pulls in 12. So you've got a nice net credit of about 455 from what we saw on the other page. That alone will bring your break even down from 182.50 to right about 178. But this break even is now lower because it's a 2.5 point spread. If the stock comes back to 180, you've got a profit of 2.6%. Keep in mind that's $2.50 below your original cost basis. Because if the stock was trading right at 180, what happens? These two calls expire worthless. You kept that $12 premium you took in. This call is now worth $2.50. So you get your, what I say, $4.55 net credit that we saw from the other page. You get $2.50 as well. So you've got $7.05, right? So at 180, 705 from your cost basis of 182.50, but you're at a profit of 455 because of this value. The extra value of the long call, the net credit originally received in, and there you go. But even though this is a repair that got you back to break even faster, Binh, remember this is just like a covered call. If BABA jumps back up above 180, goes to 185 or 186, and you want to stay into the position, I'd leave the bull call open, the 177.5, 180, one contract of each, or how many shares you have. Leave the bull call there or close it out to get the max 250 back or close to it, and then roll the extra call as you normally would as a covered call, because that is capping your upside gain. Okay. Now, why did I say this might not be the better trade? Well, in this case, we were looking at a 250 spread. We got a good net credit out of this position, and we're selling the 180s, which caps the max gain at 2.6 if action is not taken. Okay? So let's go back. Let's close this down. Let's go back. What about this 177.5, 182.5 with a net credit of only 245 and a break even of 178.78? Again, this is for the May 31st expiration weekly series. I get $9.98 here. So again, that's the only $2.50 net credit, 240 net credit we saw in that position. But now here, if the stock moves up to 180, we're making about the same 245, or we're making 400 on the other one. No, it was about 245, 2.6%. And then if it goes higher, no, it was 400. I'm sorry, 450. So this is a little bit lower here. We're only getting the 250 back from that call. But if it's up at 180, 250, naturally, because we've sold the higher strike prices and the stock hits that target, so potential for 4.1% return, and then you'd manage the 182.5 call. Okay. Binh asks now, he says, I'm greedy and I want to sell higher. I understand. You said you want to sell the 195s. To go that far out to see a repair, of course, you've got to go to June or January. My apologies. See, the other repairs weren't built. Here's one at 190 in August. But the premium for the June 195s, 190s, Julys aren't there to make the ratio spread work. If they were, they would appear on the screen, Binh. Okay? So just because a ratio is available and gets a credit for you doesn't necessarily mean it's going to be a good repair or still allow you to get to a 12% return on the position. Let me go back. Sorry, let's go back here. And yeah, I'm going to go to the 177.5, 180 again. I'm sorry about that. There's that first one we saw, the max return of 455 at 2.6%. So I can look at the chain and tell you right away if I went to, let's go to, give us time. Let's go to May 31st, okay, 21 days out. The 195 is at 163. So easily I could do a ratio repair bin at 190 and 195. Buy one and sell two, and I'm going to get a credit of about 60 cents. Okay, that's not too bad. But what is the whole point of the repair? The point of the repair is to lower your break even. Not only by the net credit you receive in this case, which again is about, I'm sorry, it was under that, is about 70 cents. So you could still have a return of 10% if it went up to 195. Okay, if it went up to 192, your long call is still worth 2 points. Hey, that's great. And you still have a maximum profit here, but you need such a wider move. But remember, the hedge you got is only 70 cents now. We are seeing hedges of 450, 240. That's the benefit of the repair around the at-the-money strikes, is getting you a higher net credit to help you get back to break even faster. If you're trying to maximize return on this because you think it's going to recover, the stock repair might not be such a great idea. You're only down by about 4 points, as we saw. You could see right here, you could just sell the May 31st 190 call. Yes, it'd be a capped gain, but you'd get about half of the unrealized loss you have on it right now. Okay? So I'm not so sure there in that case. Now, John, I'm going to take your question second. John asked a question related to the stock repair tool, as did Givenson. Givenson's question is more related to the stock repair tool itself. And John, I know yours is too, but I'm going to talk about the ON position and the other positions as well in just a moment. So first, Givenson, does the stock work on options as well, or is it just stocks? Okay. I have used the stock repair tool in some presentations, Givenson, to show how it might be used on a long call. Unfortunately, this is not a put repair. Okay, this is not a, how would I use a put repair? Well, if I was short stock and it was moving against me, I would look for the short stock repair, and it would build me hopefully a put ratio spread. currently don't have that built into the system. The programmers don't have that built in the system, I should say. It's something that should be there. Could be there. Now, what did we just do with the stock repair? We put in our cost basis for the stock knowing we have a loss on the position. I might use a higher, I'm going to use a higher one here, Givenson, okay? But let's take BABA for example. What is this 182.50? It's what I paid for the stock, right? Absolutely. Now, what if I had bought, let's say, a June 182.5 call on BABA before it pulled back, and I paid $4 for it? Well, my cost basis isn't $4, but my break even is 186.50. The cost of my long call strike, 182.50, plus the $4 I paid for the position. So I might try to use that, 186.50. Okay, I'm going to submit it. Now, I probably don't want to, I could use a May repair, but it's tricky. I'd probably want to use a June repair that has the same expiration on my long call. And here we have buying one. Oh, this one won't, you can't do this one. Okay. I can't do any repairs in this case, Givenson, where I'm selling the 182.50 calls for the same expiration of the call I own. Why? Because my broker would just see that as a cancel order. I'd be selling to close the one I have, and then I'd be in a bull call spread, which might still get you back to break even, but that's not what you want. I want a nice even one. That's not a good credit. It's not giving me what I want. I'm looking here in June for the 180 to 185. I'm going to use the 5 point. I'm going to use the 177.5. Oh, no, I'm sorry. No, I'm not. 7.5 points. I'm going to use the 177.5, 185. Okay, so here's another trick. I want it to be above the two options that I'm selling. Remember, in this column, I want that to be above the call that I own. If I did it below, it'd be a little bit different. We're going to take a look at that in a moment. Okay, but here is not a great net credit, but a credit of 125 for the 177.5, 185. Let's go to Analyze Trade. That takes you to the profit and loss chart that we just showed before. Go. And we'd have a max profit if the stock's at 185 of 3.9%, but we're not long the stock, are we? Let's take this out. Oh, and this is the 7th of June expiration, so I'll use that. And I'm going to put in my 182.5 call. Okay, $4. This isn't going to work out too well because I didn't realize it was above $4. My apologies. So what did I have to do there? I had to change the structure, right? I had to take the stock out and add in my long option back in. And that would sort of work, right? My break even's now 180.25 for the spread. Okay, not 186.50. I know that was a little complicated, but that's how you can do it. That's one way to do it. Let's say I actually paid $9 for this call, for that 182.50. So my cost basis, which you saw was now down at $5. Let's say I put 9 in, so I'm at 191.50. Okay. All right. I've got a May, got a June, and there it is. That one's still there. Okay, good. So it still gets us back to break even at 183.88. So let's analyze the trade again. Let's go back in. The net credit is a little bit different, but I don't have the stock at 191.50. I've got the June 7, 182.50 strike that I paid $9 for, and it's now down to 560. Does this still get me back to break even? Technically it should, because it's all mathematical. Okay. Break even still at that doesn't look right. Break even's at 183.88. Oh, I'm looking at the current stock price, yeah. So the break even's at 183.88. Did it do its job? Well, I don't need the stock to go back to 191.50 to get back to break even on my 182.50 call. I just need the position to be at 183.88. What happens at 183.88? Well, remember, we did take in a credit here of about 75 cents. So that lowered the total cost down to $7.75. Oh, I'm sorry, $1.25. My apologies. It's $1.25 net credit. So the total cost is $7.75. The 9 minus the 125 net credit. You've already lowered the cost here. At 183, what happens? Your long call is going to be worth an extra 50 cents. You sell to close that for about 50 cents, right? Your other long call from the ratio spread is going to be worth about $6 and is it $6? Yeah, $6.30. Okay, so right there, oh, it's 183.88. That's not 50 cents. It's over a dollar. This dollar, I'm sorry, guys. $1.38 would be the value of 182.50. 638 here. That puts you at 775. You're at break even at 183.88. Oh, and your 185s that you had an obligation on to sell to close to expire worthless. Now, if they keep going up, you can still make a maximum profit of 225 or 29% against your investment. So long story short, you can use it for long calls as well. I don't have one for long puts right now that would build a ratio in reverse on that scenario, okay? But it can be used for options. I wouldn't if you've got a bull call spread, a bull call debit spread that's going against you, I don't know if I would add a ratio on top of that. Why? Because the one thing I'm not trying to do is end up with a naked call. In either scenario of just owning the stock or owning the long call, what does this now do? Well, what you've essentially done here is you've added a 7.5 point bull call debit spread and turned your losing long call into a 250 bull call debit spread, where if the stock moves up, these strategies work and get you back to break even. But if I already had a bull call debit spread, then I did the ratio, what you'd end up with is another bull call debit spread at different strikes to help you get back to break even, and the naked call position, which has infinite risk to the upside, which you need the direction to go in order to get back to break even. So that would be an extra short call, and you'd have to put up the margin to do it. But on just a long call, you can use it in that fashion. Again, one last time, your effective cost per share would be the strike price of your long call plus the cost you paid. See if there's any ones that are available for repairs. Go to Analyze Trade. It automatically puts in the stock and the ratio spread for you. But then on the profit and loss chart, take the stock out, put in your call, and put in your cost. And if I did have a June call, Givenson, and I ran this scenario and no repairs were found out to, let's say, until September, I wouldn't do that ratio repair. Why? Because remember, I'm selling 2 and buying 1. Selling 2 Octobers, 2 Septembers, and buying 1 September. And I'm long a June. It'd be sort of like a reverse calendar because my option I'm trying to repair is shorter term. It has a defined expiration at June expiration. In order to avoid being in a naked call, I'd have to now close the whole October spread or buy another call for September or October, which would change the dynamic again because of the new cost basis, and it might not be a repair. Because I don't want to end up having the naked call hanging out there for that repair position. Okay. All right. Now, I'm going to pause the screen for a moment. I'm actually going to log off of our trial account for the moment to handle John's question in relation to the stock repair tool. Okay. All right. It's complicated, yes, but good to know. Okay. Thank you, Givenson. Yeah, I'm sorry about that complication there. But again, I just want to remind everyone you can do it that way. It's just an extra few steps because it's designed to be a stock repair, but you can use it based on what your break even would be for the long call position and then go on. Okay. All right. So John is one of our, there we go. Just logged into my different account. John is one of our Fusion subscribers at RadioActive Trading, where they follow along with the married put trade positions. with the decline this week, ON on semiconductors, one of the ones that John has been trading with me. In a sense, the trade I posted when I opened it, it was up as high as I think 23.80 at one point. So we bought in at 22.77. I'm holding the January 25 put for 420, which is a maximum risk of 7.3%. John is asking, a stock repair tool for ON, is it worth looking at now? My answer is no. Okay, here's why. That ratio repair that you looked at, John, that you just saw, for your nomenclature, for the owner of the blueprint, that's essentially income method number 5. But you know there are rules to income method number 5. Okay, I'm still holding, I don't know if you are, John, but I'm still holding the January 25 put, which means what? To me, that means that in order to use that particular adjustment on my married put position, the sell options I need to use are the 25 strike or higher, even in the ratio spread. Okay? Because if I don't, I'm going to put myself in a position, if I did, say, a 22 strike, bought a 20 and sold 2 22s, or bought a 20 and sold 2 21s, I'm going to be in a position where I'm actually going to lose money to the upside if it continues up because it's too far below my put. Okay? So, an example, 22.77 is my cost basis for ON, probably roughly the same, near the same as yours, John. And if I go to the insurance tool, we put in ON. There's no guarantee we'll even find a repair. Oh, sorry, not insurance. I wanted the stock repair tool. Apologies. All right, ON. Cost per share, 22.77, 100 shares, for example. Okay. I have a repair out to October. Hey, 2022, just like I said, 50-cent net credit lowers my break even to 21.14, positions almost there. All right, so what would I do? I'll go to Analyze Trade again. We pull up our profit and loss chart. And buy 1 October at 290, sell 2 at 215. You know, $4 and some odd cents. There's our net credit. Okay. Oh, so yeah, about $1.40 net credit at midpoint. Oh, that's weird. The bid and ask didn't fill in right. I gotta have the programmers look at that. I'm just curious. I think these might have wide bid-ask spreads too, which is something else to look out for. Oh no, not bad at all. 270, 290. Yeah, 280 is a reasonable price. Okay, that's good. Good. All right. So in any case, there's my repair. I could turn this loss into a 2.9% gain on or about October if the stock only comes back to 21.14. In this case, 20.69. Okay. But that's not my position, John, is it? I'm not in a stock position. I'm in a stock position where I bought a put, but even though the stock's now down 10%, I'm only losing about 5.4%. Okay. I clicked on the 20. I'm sorry, that's the one. I clicked on the wrong one. Let's go to the 50-cent one real quick. My apologies. I'm sorry, John. Fantastic. That makes much more sense. Get 340 for the 2 October 22 calls, 290 for the long. That's our 50 cents. 7.8% max profit potential if the stock's trading at 21.14, just about 30 cents or so, 20 cents off of where it is now. But again, this is not my position, is it? What is my position? Let's move this over. I am in a stock and put combination where I have a loss of about 5% right now with the January put. And if I did this repair, we saw it to October, buying a 20, selling 2 22s, still a max return of 5.2%. Just 1 second there. Let me submit that again. It didn't draw the graph right. Okay. That's better. What's the problem? Now, I'm not saying that ON, I'm bullish on ON. I still think it's going to recover. But you get that break even at 2090. Fantastic. You lower the max risk goes up to 8.3%. Okay. Why? Well, because of the construct of the trade. Yes, we received a net credit. this 8.3% is not down here, right? That maximum risk is lower, John. 8.3% is in this direction. Okay, we now have two break-evens at 20.90 and 24.24. Stock starts to go past that price, we're losing money. Why? Because we've got different combination now, but essentially we've got a collar position, put original, that's out to January, October call, and we've got a bull call spread. But because the short options are so far below the strike price of the put, once it goes beyond our short call strike prices, we don't get any more positive benefit of owning the stock, and the put is declining rapidly. Okay, this is not necessarily a structure I want to use. And it's all the way out to October, which I don't like anyway. But this is not a structure that I'd want to use. So you might ask, well, what are we going to do with ON? Well, I was going to do some moves today on all the open fusion positions in my portfolio. Trex, ON, well, okay, the three positions, Trex, ON, and, wow, I almost said Starbucks, and I know that's not it, sorry. NRG, wow, okay, I thought, okay, but here's why. Yes, I'm down on all of them, especially Trex. But this thing has gone up to 76, as we saw, dropped down to 59, came back up to 76, dropped back down to 59. It wasn't time to add another put yet, John, because honestly, I missed it. It happened too fast on Tuesday and Wednesday. So even at Wednesday, the market still went down a little bit on Thursday. The volatility was high, and buying the extra put wouldn't have been a benefit. So I was waiting for the stop. I was waiting for them to stop hemorrhaging money and start turning around, and now they did. So what I'm likely going to do with both ON and NRG is we're going to move the January higher strike puts, the 45 put, probably take this profit that we have on the January 45 put with the decline, sell that out. I'm probably going to buy a September 40 or maybe an October 40, closer in, lower strike to get it back to break even faster. On is probably going to be dropped down to the 22 strike, maybe the 22.50. Move in closer from January as well. Take the credit off the table. Lower the break even. Once I move ON and NRG down and in, following what I think is the rules in the blueprint tell me to do and my expectations of stock, John, then once that's done, and I have my new risk in hand, and I have my new evaluation, my new lower break even in hand, now I'll say, well, what if I did an income method number 5 to get back to break even faster? Or an income method number 6 to generate some income and leave the upside open? That's when I'm going to do it. Not now, because any repair that would look to be good for ON as a stock repair is good. And you saw it would work. You know, stock's down 7.9% from where we bought in, 8%. We could repair it if we just own the stock. But we have to look at the position as a whole. Doing that stock repair, holding the January 25 put, doesn't give us the combination we want to get back to break even fast. You've got to take that all into consideration. Okay? Trex is going to be a different one. That's coming up to July. And, you know, we've got a $9 gain on the stock. We've only got a $4 loss here with the stock down 17.7%. What I'm likely going to do with Trex, by the way, is take the profit off of this put, this $9 gain we have on the put, take that off the table, and maybe now look to go to an October 65 or 70 to lower the break even. So I'm going to move that one further out in time. Okay? All right, so we're going to see what we do there and move forward. And yeah, as you can see, these puts here, that's part of the discussion. We always go at least 150 days out in time when we open a new radioactive trade, a new married put position. And John's saying that now he sees the advantage of starting the put with greater than 200 days out in time. See, I still have 252 days to go. I've been on for 31 days. The advantage is that I can shorten this at any time and bring it closer in to lower my break even if the stock is not meeting my expectations. If I only bought a 90-day output to begin with, 30 days in, now I'm only 60 days left on the put. That rapid time decay is starting to sit in, and I don't have the advantage of being able to bring it in time for it to lower the cost base. If anything, I have to go further out in time like Trex, which I will do, which will increase the cost basis. So that's why I always like to start. My average time on the put, I think, is around 220 days over my last 2 years of trading. I'm sorry, last 8 years of trading the married put position since back in 2018 or 2008 is when I started. All right. So again, a little bit of complication on the stock repair, but yes, you can use it to maybe see if you can repair a long call that's going against you. There's some little rules in there, and I'll try to flush those out in a better description when we post the webinar here. But if I'm long, let's say a 185 call, doing the repair with, say, a 180 to a 182.5 ratio, buying 180, selling 182.5, and then having the 185 that I'm on that's down, losing value, might not work, because what have you just done? You've just created a butterfly position, right? A 180 short 2 182.85s, long a 185. It might not get you enough premium to get you back to break even. And remember, because it's a butterfly, if the stock continues to go up to your strike, the 185 strike call that we were talking about with BABA, or if we were in a 185, sorry, we were talking about the 182.50, you're at full loss on the butterfly. That's not what you want, right? You want to sort of leave it so that if it moves up, you think it's going to recover, then yeah, you want those strikes that you're selling to be above the one that you have if possible. Okay, if a repair is possible in that fashion. All right, and one more quick note on all of that, related to the stock repair, not the married put, but related to the stock repair. Oh, let me go back here. Okay, that's where I want to be. We're going to take a look graphically at this Trex one again real quick. Okay. What doesn't the stock repair do? It doesn't do anything to thwart this. Okay. The stock repair is, like I said, what I was waiting for was the bloodletting to stop this week and to sort of see a turnaround in the market. All that can change on Monday, which is why I didn't make any trades today. I want to see if Monday continues this trend, and then I'll make the fusion adjustments as I just mentioned for the fusion subscribers. But if I'm repairing Trex with this stock repair, what are the two things you notice right away? Number one, well, okay, there's a capped gain. There's three things you notice. Number one is a capped gain, but you could always manage the extra short call just as you would your covered call. Roll it back up and so forth. It only works if the stock does go up. On the stock repair tool, there were two sections. I kind of glossed over them, but the first one shows credit repairs, and the other one will actually build debit repairs, meaning it's still doing the ratio spread, but it can't be found at a credit, so it'll show some debit repairs in your position. The risk with doing a debit repair, if it's available, is that you add to the cost basis, so that increases the break even. Now, sure, the bull call debit spread part could still help you get back to break even faster, but if you're wrong and the stock continues down, you've added the cost of the debit to your potential losses. Okay, so that's a little tricky. I'd rather get the credit if possible on the credit repair. Here about $380, so that even if I'm wrong and the stock continues to go down, at least I still lowered my cost basis just up front alone by the net credit from 65 here to 61.20. Okay, so in that case, that's what I want. I want this to be done at a credit if possible, because the debit could add to my losses if I'm wrong. But again, the three things we noticed. One, all right, obviously there's a capped gain. Two, it works if the stock moves up. Okay, that's the idea of the repair. If I think the stock's going to recover. What doesn't it do? Address necessarily the downside other than the net credit received, which is pretty good in this example. It's good. A 380, a 5% yield for doing a ratio spread against this stock. That's not even including the benefit of the debit between the two strike prices. Okay, but again, so one is we have a capped gain. Two, we need the stock to move up. Three, it does not address the downside if the stock continues to fall. If you want to stay in the position and you've got a loss, an unrealized loss on the trade, you want to stay in it, but you're worried it might fall further, there's some ideas there on that Manage Your Broken Position webinar. If you have the capital, you could average down and then maybe use that insurance tool to find a put that could stop the losses from going further while leaving the upside open. And as you saw, we could still do other adjustments against that married put structure. But remember, if you have a 10% loss on your stock, you're planning on staying in it for the recovery, but you don't want to lose any more. And you say, well, I'm going to buy an October put, and the time value is 4%. What does that mean? It means you're still potentially locking in the 10% unrealized loss you already have and adding the 4% time value to the potential loss as well. So you might lose 14% if the stock continues down below that strike price. You wouldn't lose more than that, but it's not yet recovering, right? It's not yet recovering the 10% loss you made. You'd have to do something else like the stock repair to do that. And John brings up a valid point, which of course John has discussed in that Manage Your Broken Position webinar. He says, or just use the KISS principle, exit that trade and find another. Exactly. Sometimes there has to be a floor. There has to be a floor on your trading plan, meaning that if you have a stock that's down 20% and you think it's going to recover long term and it continues to move down, at some place you have to have a floor. You have to say, look, it's not, there are stocks that are going up in this market. There are stocks that are performing extraordinarily well in this market. Mine's down 25%. That's not cutting it. I don't want to take a 25% loss. I don't want to hold and hope. I don't want to think or hope. It might be best to just get out and move on. And personally, with the stock positions or covered call, most of us here are options traders, so you probably have some stock. And then we talked about ways that we can repair the broken stocks and ensure unrealized gains and protect even stocks you have a loss that you think are going to recover. But at the end of the day, a covered call. I have talked with investors over the years. I've been with PowerOptions since about 2001. And over the years, I've talked with investors who have just let their stocks go down 30, 35%. And they said, well, I was told and I was taught that you don't care if the stock falls. You just keep selling the call. Okay, well, your stock's down 35%. If your average yield on a 1 month out covered call is 2.5%, what are you looking at? Well, you're looking at almost 12 to 15 months of writing a call just to get back to break even. And clearly your stock has not been performing well. So 35 might not be the bottom. This could continue its decline and go down 40, go down 50, go down further. I've had a stock that was down 60% before in a married put trade. I only lost 4% on it. Of course, I had one that was down 30% and I made 10. But in any case, that's the idea, is that eventually in these positions, as John mentioned, sometimes you've got to cut out. No one wants to take the 30% loss, but if you're looking around the market and saying, my stock that's down 35% has to recover soon because all the other stocks are moving up and it's still not, what does that tell you? Get out of that stock. I know you don't want to take a 35% loss. Some stocks are not worth trying to manage and not worth the time to try to get back in. Maybe look at some other stock positions at that point. Maybe consider going into other stocks right now, taking what capital you have left, going into other stocks that are performing well, and go that way. Of course, this is also the reason why 50% of my actual options trading portfolio is devoted just to the married put positions described in the blueprint. So even if I do pick wrong and in a 20-day period I have a stock that falls 30%, the most I can lose on the married put structure is 5 or 6%, and the cost of the put is usually only a time value of 5 or 6%. That's the true risk, is 5 to 6%. So that's just the added cost on the position. So if it goes up 15%, I'm still probably making 9 or 10% on the position. And I could still sell calls against it or do other income methods that are discussed in the blueprint to lower this risk and eventually bulletproof the trade while increasing profits as well. And that's what John's doing, following us over at the Fusion subscription, as well as being a PowerOptions subscriber. And those positions that we talked about today on NRG, TRX, those are the ones in my Fusion portfolio right now. And of course, that the Fusion subscribers can follow with the radioactive trading techniques. But I don't have to worry about the stocks being wrong. Even if they are wrong, I only lose 4 or 5 or 6%, and the worst case scenario. All right. Well, ladies and gentlemen, I actually don't see any other question. Oh, no, there we go. Fantastic. It's a long one. That was John S. that asked our original question about the on position. This is John N. All right, and this is a long one, so there's nothing wrong with a long question, but I have to read it slowly so I digest it here. John N. says, not trying to reinvent the wheel as a newbie, and you've probably thoroughly researched this approach, okay? I studied the blueprint and chatted with Ernie. Got his mantra that the earnings per share growth is king. I can't bring myself to say Trump, okay? But since our modest loss is set with the married put, so he's talking about the stock selection and the married put search. Here we go. Just bring this up real quick, John, so everyone's on the same page. Our default search criteria, what we use when we open a new married put in the radioactive trading technique, is shown right here in PowerOptions, our criteria for the put and for the stock. And Ernie's philosophy is that the stocks with the highest earnings per share growth will usually drive a higher growth in the stock. Okay, so that's why it's sorted by the highest earnings per share growth, the results there at the top of the screen. Okay, so that's what John is referring to with the mantra of the earnings per share growth. But it seems a high volatility stock with a relatively low IV percentile trading within 30 plus of its 52-week high, okay, would be the best candidates for the 5% gain we want early in the trade. Sensible or silly? I'm starting an all-married put portfolio on the first market uptick. Thanks. Okay. It's a fantastic question, John. I get it a lot. This is one of the reasons, John, why I also logged into my personal account away from the webinar account, because I was doing something for all our Blueprint owners and Fusion subscribers. You'll see 3 webinars, hopefully next week, not live webinars, but you'll see 3 video postings of further education for Fusion subscribers and Blueprint owners. One on income method number 12 that I've been promising John S. for 2 weeks. I have that essentially done. I just have to record it. One on comparing income method number 5 to income method number 6. There still seems to be a little bit of modest misunderstanding there of the 2 income methods from time to time. And the last one is, should you feel confident with the search results on the radioactive trading default screen? And my answer is absolutely yes. And how do I know this? Okay. All right. It's my portfolio. This is the radioactive trading portfolio, of course. You see here, I've got some comparisons. What are the comparisons? Let's say that I opened the top 3 or 4 trades for the radioactive default search on September 6th. The stocks would have been Atcore, Premier, Planet Fitness, and Starbucks. From September 6th, 2018 to today, not including the married put, this is just for stock performance purposes, what have we got? It's up 11.4%. Well, that doesn't sound great, but remember, this includes the run-up to the beginning of October, the October, November, December decline, and the rebound from December 26th to about April 15th or whatever, before we started to turn again. So the radioactive stocks, the ones that match the radioactive criteria with the proper put structure, but those stocks that matched in were at 11.4%. Same date, September 6th, top 3 Dow 30 industrials were down 5.3% over the same time frame. Cat, Nike, and Walgreens. Using a MACD cross on September 6th, only stocks that have crossed over the MACD line were at a complete break even. KBH, OMI, Pilgrim's Pride, Synchrony Financial. NASDAQ 100. Positions that matched what we would buy as a married put, meaning that the stock and put combination wasn't a risk of greater than 8%, and that. But just looking at the stocks that would have come up in that search, 0.7% from September 6th until today. That's the NASDAQ 100, a little bit better than break even. S&P combined list, using stocks just in the S&P 5-star, negative 0.7, below break even. Value line, negative 8.3. This was a combined value line list. I took all value line lists and combined them into one master list, ran the married put screen, and just took the stocks. This is disastrous. Now, with the married puts, this loss of 7.2 on Caterpillar might have only been 6%. And this one here would have only probably been 7%. And this one probably would have been 7 or 8% on Walgreens Boots Alliance. But you see the comparison I'm trying to show. The stocks, why are we using the stock list that we do and the structure that we do? Because every 6 to 12 months, I run this example. I have for about 5 years now. And every time, the stocks that would have come up in the RadioActive screen outperform NASDAQ 100, S&P 5-stars, looking for stocks at the bottom feeding range. I did that 2 years ago. So a stock that was, depressed and was in the 20% of its 52-week trading range, but had recently turned, looking for bottom feeding, it did not perform as well as using the default search we did. Now, let's go forward. Same lists. January 1st. So if I'd open January 2nd, if I'd opened the top 3 positions sorted by earnings per share growth from the RadioActive trading screen, LPL Investment, PayPal Holdings, Altasian team. Customer of mine was talking to me about this stock back in November, even in February. I didn't do it. But look, the stocks alone, of course, would be hindered by the married put, but let's just use this as a straight comparison of the stocks. They're up 21.5%. Actually, on average, they're higher. The portfolio is up 21.5% because it wasn't fully invested. Still $16,000 left. I just did 100 shares of each. But I take the top few from the Dow 30, January 2nd, same thing, up 7.4. Not bad. Not 21%. NASDAQ 100s. Up 11.8. Great. Fantastic. Not 21.5%. S&P 5-star platinum list combined, only up 3.2% because AbbVie took a beating. Okay. And was that the last one I had there? Oh, the value line combined lists. Not bad, 4.8%, only 2 positions. At least Caterpillar has come back to break even after the decline it had taken. But again, we got in when it was starting to move back up. Starbucks looking fantastic as well. But again, keep looking at the wrong one. Normal RadioActive trading screen. Top 3 stocks running January 2nd, 21.5% performance. Okay? So, that is my answer about reinventing the wheel. Now, I haven't run your screen, John N. Sorry, but I will. I'll take what you said, and if you want to send me an email this weekend to clarify what kind of stocks you would look for, this bottom feeding type idea. I don't want to say bottom feeding. That's not a proper term to use. I'm sorry. Forgive me for using that term. But, looking for the lower 30th percentile, I think you were saying, of the 52-week range, and looking for a certain type of pattern or maybe a recent MACD crossover, send that to me. I'll run the same search with the married put criteria. In other words, I'll take your stock filters, put them into a search. I will put into the RadioActive screen, still looking for a risk of less than 9%, stocks under $200, and yada, yada. I'll put that all in. I'll take the top 3 stocks and what they were at that time, and we'll compare them to Dow 30, MACD cross open, NASDAQ 100, normal RadioActive trading default screens, S&P combined list, value line, yours, MACD cross, and more. Okay? So I'll put that through, and we'll see how it stacks up. But again, like I said, about every 8 months, every 10 months, the questions start coming in. I question myself sometimes. John S. can attest to this. He's entered into 2 of my married puts in fusion with me. You just saw the on position is not doing that well, but yeah, the put's out to January. I've got time to manage that, and I'm going to, as we just saw the uptick that John N. was mentioning. That's when he's going to start opening his married puts. But every time I run this comparison, the default RadioActive screens, the stocks that would have come up in the default RadioActive screens, outperform the other ones. And of course, now that I've gone through that, essentially, you've just seen the numbers very quickly, but Blueprint owners and Fusion subscribers will get the full details on all of that when I put together the webinar next week, record it, and it'll be posted in the Fusion section and members only section on RadioActive Trading for Blueprint and Fusion subscribers. Okay. All right. Oh, and I see John says, how often do you talk about, you're talking about these lists, this NASDAQ 100, how often are they updated? I think it's, I know that one of the lists is updated every Wednesday and Sunday. I think it's updated twice a week, and I'm pretty sure we're doing it twice a week as well. We're trying to be as active as we can with that, but I know one of those lists did change to where they were doing it twice a week, and at first we were only doing it. You don't see much of a difference between the 2 days. I think it's a difference of maybe one stock at a time. Most I've heard Ernie say is 4 stocks came out and 4 new ones came in. It's very rare. Binh says, can you run the latest rat now? Yeah, that's it. Just go to married put. Just go to search. Here's what you get. EDU, KRNT, GWRE, Teradyne, horizontal. I've been looking at Kirkland. That was a married put I was going to enter this week. And this one, too, is very interesting. BPOP. Never heard of it before. Popular group. Kroger, I'm still skeptical about, even though it's in the list. And there's that LPLA that we looked at that had the long run as well. So those are the 4. Monster Beverage, I see this come in the list a lot. I've actually never traded. I've probably missed out on some good profits on that one, depending on the time frame. Depending on the time frame. All right, Ben, so there you go. That's what the married puts look like now. Okay. All right. Okay, John, good. I'm sorry, I did misunderstand your comment. Yeah, so 20% plus or minus off the high, not bottom feeding. Absolutely. So send me your specifics there, and I'll look for it as well. Interesting comment from John S. It says, EDU is super bullish. How much longer? LOL. Yeah, I don't know. I think Greg is actually in this married put, if I'm not mistaken, in his Fusion portfolio. And what's funny about this, we talk about it all the time. We've got these hiccups. I'm going to go back 1 year. We talk about these hiccups and everything that have come out recently, the volatility, and yeah, this has been a straight bad decline, and then it reversed here. Okay, and someone takes a look at it and says, oh, okay, well, it's got to be depressed now. It's come off 20% off of this, almost 40% off of its low here from December. So this has got to be the high. Well, it's only the high until the next high. It's only the new high until the next high. It's only the new high until the next high. And it's not the 52-week high yet, right? That's at 110. And this pulled back with everything else the last 5 or 6 days. But this is, I want to see this just as, I'll be honest with you, just as John N. mentioned, this is why I didn't do the adjustments today. I want to see if this uptick is good for tomorrow. And this one still dropped, and some of them still dropped, but a lot of them recovered by the end of the day. I want to see this start to turn. I want to see this start to turn. And this to go up. Wouldn't surprise me if this comes back up to this range if the market goes back without any hesitation or other outside spoken things as well. Okay. All right. So, yeah, I don't know if I'm bullish. I see exactly what you're saying, John. I don't know how much longer that bullish run can last now. It's depending, I think, on, it wants to. To me, it looks like it wants to, and it got pulled down with all the rest of the market in the last week. Let's see what happens going forward. But once I see some of these things turn, I'd probably be a little bit more reasonable into a bullish trend here. We'll have to see. But hey, if you opened it this way, even if you're wrong and it drops 14%, the max you're going to lose is 7, and that's out to January. So if it falls 14% between now and, let's say, August even, you're probably only losing 3% because that put's still going to have a lot of time value left on it. This is the worst case scenario, the absolute worst case, as you know. At expiration, between now and expiration, that loss is going to be much mitigated, even if there was a 14% drop. All right. Well, I think that was all the questions that I had come in, all the comments I wanted to make today. I want to remind everyone, of course, to check out the stock insurance tool that we talked about and the stock repair tool for the drops that you've seen recently. And of course, I do want to remind everyone as well that today's material, of course, are my thoughts on your questions and the tools I wanted to show you today to help maybe get through what happened this week with some of those stock repair ideas and insurance ideas and the tools that you can use. But they're my thoughts and your questions designed for educational purposes, increasing investing performance and options knowledge. Any stocks or options discussed today should not be taken as direct trading suggestions or recommendations, even though we showed some statistics to prove why that default Mary put search is still working well. But in the end, options involve risk, may not be suitable for all investors, which of course is another reason to look at the radioactive trading married put approach as well. Now, to take advantage of those tools you saw today, the stock repair, stock insurance tool, and others that we looked at, and the search tools, just simply go to PowerOp.com, put in your first name, last name, and email address, and you'll have full access to a 14-day free trial to PowerOptions. And of course, as a trial member, you can subscribe. You can schedule one of those coaching sessions at any time, and you can have as many sessions as you want during your trial. After that, our subscription levels start at $40 per month for the end-of-day data, only $60 per month for the delayed service, 15 to 20-minute delayed data. Other free stuff, of course, I already mentioned the webinars page. You can also check out our blog, blog.powerop.com, for free educational articles and more. Always, you can check us out on YouTube, of course, just under Power Options, and you can always follow us on Facebook as well, of course, under Power Options. And if you think of any other questions later time, John and I'll look for your email this weekend. But if anyone else thinks of any other questions, just send me an email to support@powerop.com or to support@radioactivetrading.com. You can also call me during market hours at 302-992-7971. If I'm not available, you'll get the president, owner, and founder of Power Options, Ernie. And of course, trial members and subscribers, you can schedule that coaching session at any time. Ladies and gentlemen, thank you for joining me for today's discussion. I look forward to seeing what the market does next week, and I hope to look forward to seeing all of you next week. We'll be back here Friday, but we'll also have some other archived webinars, new material webinars pre-recorded available for you next week, both on Power Options and at Radioactive Trading. Have a great weekend. We'll see you soon. Good night.